Hey everybody, welcome to Friday's market wrap-up report here at Verified Investing. My name is Gareth, Soloway, Chief Market Strategist. Now, what a week. Markets again, head and shoulders pattern on the S&P. Looks like it has triggered today. The jobs number coming in massively higher than expectations, around 263,000 jobs added, over 100,000 more than expected. So lots of big things going on, yields surging to the upside, which the market does not like. And just remember, the Fed was all about cutting rates, 100 basis points thus far, and rates have gone in the opposite direction now, 120 basis points higher. Let's take a look at where the markets stand now, just on this Friday market wrap, and see where we are today going into the weekend. Because listen, when you're a trader or an investor, you got to be ready. You got to be looking at what the markets did into the weekend so that you're ready for Monday when the action comes. What levels are you ready to trade? That is key. All right, here we have the Dow Jones Industrial Average down 625 points, a walloping of 1.5%. The NASDAQ down over 1.5% or 300 points. And the S&P 500 down 75 points, a little bit less in terms of percentages, but still 1.25% drop. Now, oil surging to the upside, partially the strong U.S. jobs data, but in my opinion, I think it's more of a safe haven trade. I know it sounds weird, but when money's rotating out of big cap tech, and you can see over here, NVIDIA, Apple, Microsoft, Google. I mean, look at all this red on this board today. That money is being pulled out of a lot of these names, and it's looking for a home. Generally, when you're an institutional trader running a hedge fund, you don't want to be in cash. So you're looking and saying, okay, well, we're pulling money out of this. Now, where do we put it? And to me, one of the recipients here is oil, up about $2.29. We'll cover that chart in just a minute. Gold is also rallying, right? Safe haven asset. That's all you need to know, is that gold is that safe haven. Interestingly enough, Bitcoin's bouncing today. Where is it bouncing? Off the 92,000 level that I've given you guys. That is your key support level, and it is getting a bounce today in spite of the risk-off trade. That's another interesting factor there. Taking a look at the S&P 500, this is the daily chart of the S&P. Again, S&P down right now 1.5%. Here we have that classic upsloping trend line. We'll show that. I'll zoom out in just a second and show that to you where that comes from. But again, there's been so many signals, guys. You can't say that I haven't been screaming at the top of my lungs to warn people that this was coming in January after the cycle date on December 15th. Here's a shoulder, here's a head, and here's your shoulder. Now, if you take that line and you draw that through, we have now breached the neckline of the head and shoulders pattern. That means it is now triggered. Doesn't mean it can't fail. Anything can fail at any point. It means that now probabilities favor continued downside. To do a measured move, you take that from there, drop that plumb line down to the neckline, and you take that distance and replicate it down. I believe I've done this before on my own and calculated out around 5,600 would be your price target for the S&P. And listen, we're already at 5,800, so it's not that far away. Just remember, folks, when we were heading up towards 6,000, remember my level 6,000 to my high-end target was 6,100 on the S&P 500. And where did we hit right here? 6,100. Right to the dollar or to the point amount. That was also in conjunction. The cycle date was right here that we had all of that right there telling us markets were going to be changing, a change in character. And certainly we have seen that change in character take hold. Now, the nice thing about cycles, they work both ways. So we do have new cycles that we're running. We're looking at where's that next cycle date so that that could be a turn in the markets, potentially in the opposite direction. And we'll obviously keep you posted here at verifiedinvesting.com. All right, back to the chart. I promised you guys we'd look at the S&P chart here and zoom out. So a couple things to take note of. This trend line's pretty amazing here, going back to 2023, touches right here. Goes there, and that was also the top. And then obviously you guys know I've really harped on this because I think it's so powerful. But if we flip to the logarithmic chart and we go to the monthly and we go all the way back to the 1929 stock market high before the Great Depression, and we put that through the dot-com high, look at where we topped. And this is why, you know, listen, anytime you could get a 5-10% market correction at any point, right? So I mean, that's always something that can happen, and it generally does once a year, every couple years. But what are the odds that it's something bigger at work here. And when you look at this chart and you go back to the Great Depression, just pre-Great Depression through the dot-com bubble, and you have literally now just touched that right there. I mean, look at this right there. That does tell you that there's a possibility it could be something more major. And then when you bring up the NASDAQ 100 chart here, and let me bring up actually the NASDAQ composite, and we look at, let's flip out of log, go back to regular, and we look at this chart here. It goes back, this parallel, COVID low, bear market low of 2022, bull market high of 2021, and look, zoom right in. What was the high right there? And look at the markets come in. And so, again, listen, right now we're on a normal correction mode. Every market has a normal correction. The bigger question is this going to turn into something a lot bigger? And that's what we're waiting to see. We don't know yet, but it has the potential to be a lot bigger. All right. The culprit of today's selling, the answer is very simple. The 10-year yield here. The 10-year yield is now at 4.767%. Big update today on the back of that strong jobs report. I did tell you guys that there was a chance that we could go all the way up to 5%. Again, let me get rid of this downside target line, which we'll talk about a little bit later. But here you have this upsloping trend line. We broke below it. There's a general tendency for charts to retrace to the scene of the crime, and that would be a retrace to that line, and then it would also meet at double top. So there is a chance we could go up to 5% before topping out. Now, eventually, these high interest rates are going to hurt the economy, right? So eventually, they're going to hurt the economy, and the economy will start to stutter. It'll start to slow down, and that's when rates will start to fall. The kicker is this. You have to keep in mind that inflation is already on the higher side, so it's not like the Fed can just start cutting rates a ton and bring us back to COVID lows of rates, right? In general, the downside's probably down to about 3.25%, and that's going to be the new normal for a recessionary period in the markets, which is kind of crazy, but that is, again, because of inflation, because of those inflationary pressures. All right, let's talk about Apple, guys. Take a look at Apple here. In fact, I'm going to go over to the big board to take a look at this here. So what did I tell you guys? Right over here, all right, right over here, I picked up puts on Apple, right? I gave you guys, I said it right in the trading the close in the game plan. I said, guys, I've picked up puts on Apple right here. All right, we had an upsloping trend line. The valuation made no sense. The slowdown in iPhone sales, there was no refresh cycle or whatever they called it. And ultimately, I said, guys, when it gets here, I'm going to take half off the table. Right at target one, it's basically this high and this high, right? Well, guess what? Look, we went right there today. So half off the table. Pocketed that profit. Now I'll leave the other half on. I fully, by the way, expect a bounce, right? You probably get a bounce, but then I think you get your next leg down. I'm going to hold the second half for a much bigger gain. And this is the kind of the philosophy, right? I mean, most people, most general retail investors, they swing for the fences, right? They're like, I just want to hit a home run, make 500%, 1,000%, do that 10x type thing. For me, I have a different mentality, right? It's the mentality of being burned and trying to swing for the fences and striking out so many damn times. So instead, what I do is I say, okay, well, I'm in the money very nicely. Take some off, put it in that pocket. So now I've got a profit, and now I can let that second half run and just relax, and let's see where we get or what we get from it. And that kind of mentality is actually the mentality that will make you more money over the longer term, because the one thing you don't want to do as a trader or as an investor is strike out a lot. When you strike out, it's catastrophic to your portfolio. So just continue to put some in the pocket at very least, and then move on, and you can let the rest run if you want, or you take it all off the table. No one goes broke taking a profit. That's one of the adages I learned early on in my career, and it stuck with me. All right. So that's your Apple chart there, guys. Beautiful dip on Apple. It's already getting a bounce off of those lows. WBA, guys, one of my January effect plays here. Beautiful move up. A lot of the January effect plays, though, are not doing well. WBA is doing well here because of their earnings. Their earnings were blockbuster. 27% gain today. I saw some of you guys did take this and had it. That is awesome. Now, one of the stocks here that's getting crushed is Wolf. Wolf is trading right now at 508, down quite a bit in the last couple days. And this is the tricky thing with Wolf, right? So what I ended up seeing is that when Rigetti Computing and all of these others, QUBT and all these others were running, there was a lot of retail getting in this name, all right? And it wasn't really surging because it wasn't really a supercomputing. I mean, it's a semiconductor play, but it's more an EV semiconductor play. What's happening now is liquidations, right? So essentially a lot of these retail investors that piled into these, they got crushed on Rigetti, they got crushed on these other names out there, and they're being forced into selling. And that's why it's driving down. Now, for me, what am I doing? Well, I picked some more up today. I'm like, all right, so I started my last entry with members of Smart Money Stocks was in the 6s. Now I just added today around 5 and change. We got our average down to 6. I'm going to continue to just slowly dollar DCA into something like this. They got $1 billion in cash, and their chips again. You know, if you think about the energy needs of the future, that's what their chips are about. They're better energy chips that again are lower energy. They're more energy efficient essentially from anything on the market. So listen, it's not to say this can't go down, because if the liquidations continue from retail, that's going to drive it down. But for me, I'm just holding out my hand and saying, okay, sure, I'll have some at 5, I'll have some at 475, I'll have a little more at 450. That's fine with me. I don't mind accumulating as it comes down. All right, we do see it's at a T technical area right here, so we'll have to see if this ends up bouncing. But again, ultimately, what am I looking for? See this downsloping trend line? Right here, and it actually goes back a lot further, all these little levels here. We need to see a breakout above that. That's where the momentum would come in. That's why the momentum honestly couldn't get through there. The shorts in this are not letting it. Once the shorts get squeezed through this level, that's when you should get, I should say, your bigger moves to the upside. All right, so I wanted to cover that one because I think that's an interesting one. It's one I've talked about in the past, being generally a big fan in this range. But again, remember, doesn't mean instantly it's going to be accretive or a major moneymaker. NVIDIA today, big down day, 3%, another 3%, I should say. This reversal candle was everything right here. Again, that is one of the nastiest technical candles you're going to get right off double top, upsloping trend line right there, and a great reversal. You will find support around 132, though. If we hit that on Monday, that's going to be a big test for this stock. Speaking of Rigetti, down again today, trading now below $9. And again, my next level on Rigetti, not until about $7 Pierce. $7 Pierce, though, that will be a very intriguing level right down here. But again, I wouldn't be surprised if by Monday or Tuesday of next week, we tag that level. Let's get into Bitcoin here. Bitcoin actually showing some signs of life today. Now, where is it showing signs of life? It's showing signs of life right off of the key technical level that I've talked about, right? So again, I keep on letting you guys know, and I feel like a broken record sometimes, but I understand we have new people tuning in each and every time that I do these shows. But again, so many people were getting excited when we were rallying up, and I just kept on saying, guys, let's take it. Let's use logic. We know our level. This is resistance. So unless it gets above this line here, there's not a whole lot to do. Sure enough, it gets rejected. I said, okay, same thing. On the downside, you know, being neither a bull nor a bear, just looking at the chart, what is the support? What is the resistance? Here's your support. Goes right there and gets a bounce. Now, at some point, either this will fail and price will shoot through it, or this will fail and price will shoot through it, right? But essentially the idea is you don't want to jump the gun. Jumping the gun is an emotional response of guessing, and guessing generally gets us into trouble. So watch to see. We're still stuck here. For all we know, we're going to go up here, we're going to come here. I mean, we could do that. For all I know, eventually one of these will break. The question is, which direction does it go? Do I have any sort of inkling, and I've talked about this before, is that it's not a great pattern, but in general, you respect this reversal here to the downside. That's kind of what we would call like a flagpole, and this is kind of what we call a megaphone bearish pattern. So it's a slight bearish pattern, but it's not as good as a straight, like tight right angle, right? The tight right angles are the higher probability ones. This is just slightly favoring, like, so slightly would be, you know, 60-40, 55-30, 45 kind of thing, versus, you know, a tight right angle like that, that's probably an 80% success rate bear flag. And so depending on the formation, you have to understand that it does differentiate between probabilities of success on these different things. All right. A couple other things here, guys, to go over going into the weekend as we get in. By the way, earnings season starts in earnest next week with a lot of names like JP Morgan Chase and so on and so forth. But here we have gold. It does look like it's going to close above this level. Remember, a close above is not a breakout. It's a potential breakout. You need to confirm the move. It's still a strong move in gold today, up $23. And again, one of the things, by the way, that I didn't like on gold today is that the miners, the gold miners, struggled. So one of the things here, and I want to show you this gold miner chart here. So here's the GDX gold miner ETF. So you had gold closing up here, right above the line, and the miners got rejected here and came back in. Now, the miners were still green on the day, but historically, sometimes when the miners start to falter, gold follows. You'd think that miners would follow gold, but I've seen it work the opposite, where when the miners stall out, I don't know if it's big money that knows or whatever, whatever it may be, but just let's watch very closely on Monday in terms of the GDX and the miners and to see exactly what's going on here. All right, a couple other charts that I want to just briefly go over. We have silver. I know you guys, a lot of silver bugs out there. I'm still not in love with silver. It just is, it was up a little bit today, but it didn't even test this line versus gold closed above its line. So again, that just shows me it's relatively weak. Today was a jobs number where you would have said, okay, well, strong U.S. economy, so therefore silver should be ripping as the industrial side, right? Plus it has the store of safety side too. And it's, yeah, it was up 1%. That's not what you expect from silver. And so to me, I look at that and I say, okay, what are the breadcrumbs telling us? They're telling us it's a little bit on the weaker side. Maybe it doesn't believe in the jobs number, whatever it is, doesn't really matter. It's just weaker. All right, lastly here, folks, let's look at oil, which did push up. Remember, I shorted oil earlier this week. I'm under the water on that trade a little bit. I tried to add here today right at this line, and it missed filling me right here on my short, but that was my next level that I've talked about in these trading the closes, weekly wrap-up, whatever you want to call game plans. This level here, so I started my short at this line. I said, okay, my DCA is right here in this area. Missed it by a hair. Hopefully on Monday it pushes up so I can get that add, bring that dollar cost up. And what I've talked to you guys about is that eventually oil is going to come down and break 65 and eventually go to 35. Now, again, I don't know if that's going to be in 2025 that we hit $35, right? I mean, that's a pretty nasty. I mean, the U.S. economy would really be in trouble if that gets hit this year. But I do think it's on the horizon in the next 12 to 18 months that we do see $35 a barrel. So keep that in mind. Lastly, natural gas today, folks. Natural gas, again, pushing up. I have to say, I do like a short up here now. So this is established as a reversal. If we get back to this, look, every time we hit this line, we've seen a reversal in price. So I'm going to use that to my advantage as a technical trader. If we surge up here in the next week, I'm going to look to start a short position right into that line, right here around 410 to 412 probably. I will let you guys know. All right, so again, to summarize the week, the weekly wrap up here, jobs report was strong. Yields continue to surge as the U.S. economy continues to hum. Again, what is that doing? It's inflationary because, again, the more people, the better. The more people have jobs, the more people have money, the more competition for goods. So CPI, PPI, PCE, we saw them upticking already. It almost told us that this jobs number was going to be strong. Granted, could this just be a December effect? We'll have to see what happens in January, absolutely, but the markets react to the current data, and that's the key, okay? Next week, we have more economic data, but earnings really start to take center stage, and we're going to see, do yields push up to 5%? 5% is a huge, huge resistance level. I would expect a big pullback, maybe even a top off that 5% level. Thank you guys so much for a great week here at Verified Investing. Thank you for all your support, your comments. You guys are why we do what we do, pulling back the blinds and the curtains from the institutional side with the data-driven analysis that they pay millions of dollars for. You guys are why we do it. You guys have a great weekend. I'll see you Monday morning for the game plan. Take care.